Hi, my name is Carl Steigerwald. In this session today, we're going to look at tax considerations in the life insurance product. Some of the takeaways for you: income tax issues relative to life insurance. What is FIFO? No, it's not your dog. What is a MEC? What is LIFO? How are estate taxes going to play into the mix of things? And what exactly is a 1035 exchange? Shall we start? On the chart you see in front of you, income taxation of life insurance while our insured is still alive. The question being, premiums, are they tax deductible? No, they are not. You cannot take a tax deduction for the premiums. This is actually advantageous to you. The cash value growth in this contract is tax deferred. Deferred meaning put off until later. You don't pay taxes on this money until you actually take custody of this money. Borrowing from the contract or taking a loan from the contract, the idea here is you are doing this without any tax liabilities. If we have a contract, such as a universal life policy, which allows for partial surrenders, then we can, in certain circles, be subject to some taxation. The idea here is going to be whether or not we have taken any gains out of the policy. Policy dividends are not taxable. As you know, a dividend is a return of overpaid premium, and as such is not subject to taxation. As we mentioned previously, you've already been taxed on those premiums. You're not going to be taxed a second time. The diagram that you see in front of you, the little kettles with the little spigots on them and everything, this one is showing you exactly what FIFO is. And what FIFO stands for is first in, first out. Meaning the money that you put into this contract first was the premium. So when you pull money back out of this contract again, we are getting back our own money, our own premium. In the eyes of the IRS, the money coming out of this contract, as long as it maintains the integrity of being life insurance, is going to be you taking your money back out again. Your premium that you put in is called your cost basis. That cost basis is the first money that's drawn back out of this account whenever you take money out of the policy. Interest that comes out of the policy will be subject to taxation. But again, remember, first in was the money that you paid in premiums, so first out is a refund of your premiums. Proceeds paid to the beneficiary. In the event that the insured dies, the proceeds paid to a beneficiary are income tax free. In the event that the beneficiary decides that they are going to leave the proceeds on deposit with the insurance company, any money that has not been distributed is going to earn interest. The interest payments are taxable to the beneficiary. The principal is not. So in the event the beneficiary leaves this money on deposit with the insurance company and they decide that, right now I'm going through a grieving process, it's very difficult to make a determination of what to do with these funds, would you please hold on to them for me? Then interest being credited in on top of this is going to be put into a position where when the beneficiary does indeed come and take the money out at some later date, they're going to be subject to paying taxes on the interest payments that have accrued on this money. Dividends paid, if any, again, are not a taxable event. Modified endowment contracts, also known as a MEC. In 1988, Congress established something called the Technical and Miscellaneous Revenue Act, also known as TAMRA. This revised tax law definition of our life insurance contracts. It was specifically designed to discourage the sale and purchase of the insurance policy for investment purposes or as a tax shelter. It created the modified endowment contract, which is a new class of insurance policy. The provisions that we look at here in order to establish whether or not one of our contracts is a modified endowment contract is something called the 7-pay test. If the amount of money that's been paid into this contract during the first years exceeds the sum of the net level premiums that would have been payable to provide a paid-up future benefit in 7 years, this policy is determined to be a modified endowment contract. And as I'm sure you've heard or you will hear in the insurance industry, once a MEC, always a MEC. There is no going back, even if you exchange the contract for another policy. The new contract will be a modified endowment contract. In the event that we have a policy that receives a policy owner that receives any amount of money from a modified endowment contract, a loan, a withdrawal, any amount coming out of a modified endowment contract is going to be taxable. First, as ordinary income, taxable gain comes out first. Now we are in the realm of LIFO, last in, first out. The last money in was your interest. The first money out is your interest. This is the IRS. It's a determination that they have made and what they established under TAMRA. Second, it will be a return of your premiums that were paid in, your contributions. Third, it's important to note any amount that is received by the owner prior to their age 59 and a half will also be subject to a 10% penalty tax. And that 10% will be levied against the interest gains that were pulled out of this contract. The diagram you see before you is the LIFO diagram, and what they are showing you is that here the principal is in, the interest being paid in is last in, meaning that money being last into the pot is the first money that comes out of the pot under the provisions of this particular diagram and the way that the IRS views the money in a modified endowment contract. Modified endowment contracts it's any policy that allows excess premium payments. And the idea here is that in the event we've got a contract like this, it has the potential. So if this policy says you can make extra premium payments, then you can inadvertently turn this contract into a modified endowment contract. As the insurance company, it is our responsibility, it is your responsibility as the producer to be sure you make the owner aware of the fact that they could potentially create this type of a contract. It's very important to understand there's nothing wrong with a modified endowment contract as long as the client knows it's a modified endowment contract. In the event that our insured, our policy owner, circumvents the system and they don't go through you as the producer, but they send the money directly into the insurance company, the insurance company is going to be in a position where they will refund that excess premium to the policy owner. They will do so within 60 days, and the reasoning, they want to avoid inadvertently creating the modified endowment contract. Estate taxes. Estate taxes are interesting. The idea here is who owns this policy? If the owner of the policy is the insured, then the proceeds of this contract will be subject to estate tax liability. If the owner of this contract is someone other than the insured, the proceeds of the contract will not be estate taxable. Section 1035 exchange. Here we have a situation where we are going to take and transfer money from one of the contracts that we have to a new contract. The 1035 exchange allows for the tax-free movement of these funds. What's very important to understand, under a 1035 exchange, which incidentally is an IRS tax code, we have money going from one contract with one company to another contract with another company, going from company to company. And as a result, you will not be subject to tax liability. The only time as the policy owner that you are subject to tax liability is if you take custody of that money, and only then in certain special circumstances. So it is incredibly important to understand that if we have a contract where we're moving from one to another and we want to avoid tax liability, Section 1035 exchange is our best friend. We definitely want to make sure that we look at that. A recap. We looked at what are the income tax liabilities on our life insurance policies. First in, first out, what is FIFO? MEC, what is a modified endowment contract? LIFO, last in, first out. This would be the proceeds coming out of that modified endowment contract and how they are going to be treated by the IRS, estate tax liability, and then last but not least, our 1035 exchange. Thank you again so much for your time. Have a great day.